Hello, welcome back everyone. In this video, we're going to continue with Chapter 9, Purchasing, Financing, and Insuring a Home. In this video, we're going to go over in more details how to compute your mortgage payments, as well as looking at in details different types of loans. Let's get started. The most common type of loans are fixed rate mortgages. Fixed rate mortgages meaning that the interest rate and the loan payment remains the same throughout the life of the loan. The length of a fixed rate mortgage typically varies from 30 years to 10 years to 30 years. The most popular length is 30 years. Both your interest rate and the monthly payment will remain fixed throughout the entire life. Most fixed rate mortgages do not have prepayment penalties. It is important to check for prepayment penalties because it gives you a lot of options. It gives you options to refinance if interest rate goes down. And also it gives you options to make additional payments to remove your PMI requirement or pay off your mortgage faster. And finally, the option to sell the house before the mortgage is paid off. Even though we already showed that it's very expensive to move if you buy a house, there is a good chance that if you take out a 30-year mortgage, you may have to move before the mortgage is paid off. The second type of mortgage that is popular is called adjustable rate mortgage, or ARM. The adjustable mortgage typically means that the interest rate is tied to an index rather than fixed throughout the life of the loan. The index, they may use different types of index. We already see that in credit card, oftentimes the benchmark or the index for those interest rate is the prime rate. Another very popular interest rate benchmark or index is the SOFR. SOFR stands for the Secure Overnight Financing Rate. This is the rate that banks charge each other. The prime rate is the rate that banks charge their best customers. And you will pay a constant margin. So the margin is typically constant, but the base index, the index can go up or down. A very important characteristic of an ARM is how often interest rate can adjust. So here are how adjustable rate mortgages are oftentimes quoted. A 5-1 ARM means that the interest rate is fixed for 5 years and will change every year after the initial 5 year. Another example, let's say you have a 2-6 month MON ARM. What that means is interest rate will be fixed for the first 2 years, and then it can change every 6 months thereafter. So these two numbers represent the duration. So fixed for 5 years and how often it can change. In addition to the time consideration, meaning the duration of fixed rate, the duration for how long the rate is fixed, and also the frequency of change, it's also important to learn how much each change can be. And those are represented by caps. So caps is the maximum change in the interest rate. So there is a first adjusted cap. This is how much the first rate can change. So this may be 1%, 2%. So if your current rate is say 5% and the first adjustable cap is 2%, that means it can go up to 7%. Subsequent adjusted cap, this means that how much interest rate can go up each time is adjusted. And then the lifetime cap, this is the maximum interest rate that you will pay for this particular loan. The lifetime cap is the worst case scenario. This is the highest that the interest rate on this loan can go up to. The initial rate for an adjustable rate mortgage is typically lower than a fixed rate mortgage. There's really no reason to take out an adjustable rate mortgage that has a rate higher than a fixed rate mortgage today. Some adjustable rate mortgage also have an option to convert it into a fixed rate in the future. Adjustable rate mortgage used to be very popular when interest rate was high. It has been less popular in the past 5 to 10 years because interest rate has been very, very low. Interest rate has started to go up again, and adjustable rate mortgage is becoming popular once again. In the last video, we talked about examples of mortgage that are not fully amortized. These are non-qualifying, so these are not qualifying mortgages. However, with the deregulation becoming popular again, people are starting to forget what happened almost 20 years ago now, the financial crisis of 2008. Some of these mortgages are coming back into the marketplace. These include graduated payment mortgage, where the payments are very low in the early years, and they are so low that they may actually be below the interest expense or the interest portion. And because of that, the balance of these mortgages can actually increase even though you are making payments, and we call that negative amortization. Another type of mortgage is interest-only mortgage, which means that you are paying only the interest on the mortgage during the first few years. The last type is a balloon payment mortgage. This is a mortgage where the monthly payment amount is pretty low, but a single large payment is required. So you will actually have to pay off the entire balloon. That's where the balloon term comes in. You have to pay off the entire loan that is still remaining. Mortgages are amortized loans. So let's take a look at what they are. We'll use a lot of the tools that we learned in Chapter 5 when we talk about time value of money in analyzing amortized loans. In an amortized loan, the borrower will make fixed payments during the life of the loan. And this actually still works even if it's a variable rate mortgage or adjustable rate mortgage. The payment is still fixed in between the adjustment period. The most important characteristic of an amortized loan is that each payment has two components, an interest component and a principal component. The principal component will reduce the loan balance, and the interest amount is computed based on the remaining balance, not the original loan amount. So that is why you will be able to pay off the entire loan during the life of the loan. To understand how you can reduce the loan amount by making these payments, let's look at the amortization schedule. The amortization schedule has three components. The first is computing what the interest is. The interest is equal to the remaining balance times the interest rate. Next, we're going to figure out what the principal amount is. The principal amount is equal to your fixed payment minus the interest that we just computed. And then finally, the principal will be used to reduce the remaining balance, and now you have a new remaining balance that is slightly smaller. With a fully amortized loan, the loan will be fully repaid at maturity, meaning after you make all the scheduled payments. Let's look at a very simple example. In this particular example, the loan, we make the payment frequency once per year to simplify the calculation, but the basic principle remains the same. The loan amount is $10,000, so this is the original loan amount. Interest rate is 8% per year, and originally the loan term is 3 years. In Chapter 5, we learn how to use the time value of money function, the PMT function, to compute the payment. So we have 8%, that's the interest rate, over 3 years. Again, the payment is made once per year, and we borrow $10,000. We'll use the annuity payment amount to compute the payment. So it's $3,880. That's how much we will pay per year. Next, let us take a look at how this payment is distributed between the interest portion and the principal portion for year 1. Remember that our yearly payment is $38.80. We computed that at the last slide. So we want to see how is the $38.80 distributed between interest and principal. We know that the interest per period is the remaining balance times the periodic interest rate. For the first year, the remaining balance is simply our entire loan balance because we haven't made any payments yet. And the interest rate for this loan is 8%, so we multiply that by 0.08. That gives us $800. So of the $3,880, $800 is considered interest. Next, we're going to look at principal. Principal is, so we pay $38.80, so that's our payment. So if we make a payment of $38.80, and out of that, $800 is considered interest. So we're going to subtract that. So the remaining $3,080 is considered principal. And it's this principal amount, that's this $3,080 that will be used to reduce the balance on the loan. So the new remaining balance is equal to the previous balance, which is the $10,000. That's how much we originally owe. And now the bank consider we reduce this loan by $3,080. Now, not $38.80, but $3,080 because $800 is considered interest. And our remaining balance, the new remaining balance, will be the difference between these two, and that's $69.20. We'll do this again for year 2. Now that we completed year 1, let's take a look at year 2. The payment is the same. This is a fixed rate mortgage, so that does not change. In year 2, we compute the interest per period. But now our balance is no longer $10,000 because we pay off some of it. Our new balance from year 1 carrying forward is $6,920. And our interest rate remains fixed at 8%. Encourage you to pause the video and use your calculator to figure out what this amount is. Welcome back. Did you get $554? That is the interest amount for year 2. Now that we know the interest amount, we can figure out the principal portion. The payment remains the same. We make $3,880 in payment. And the interest, the bank considered our year 2 interest is $554. Once again, pause the video if you need to and figure out what the difference is. The principal portion difference is $3,327. And this is the amount that will be used to reduce our balance. Now remember, our balance from year 1 was $6,920. And now we're going to pay down another $3,327. Our new balance at the end of year 2 is $3,593. Let's take a look at what year 3 is. I challenge you to pause the video and compute what the interest will be for year 3, the periodic payment or the principal payment for year 3, and the new balance at the end of year 3. The payment, remember, remains fixed. In year 3, our balance from what we computed last time was $3,593. The interest rate remained 8%, so multiply that by 0.08. And the interest portion for year 3 is $287. Is that what you get? Hopefully so. Now for the principal portion, we roll a check or we make a payment of $3,880. Interest for year 3 is $287. So our principal portion in year 3 is $35.93. Now this is the amount that will reduce our principal. Our previous balance was $35.93. This is how much we owe in the beginning. We make a payment of, or a principal payment of $3,593, so our new balance is 0. This is not an accident, nor is this a coincidence. We figure out the payment amount of $38.80 with the intention that we'll fully pay off the loan in 3 years. When we originally compute the payment, we assume that we'll pay off the $10,000 over 3 years. Here's a table summarizing how the loan balance changed over the entire 3 years. Notice the payment amount remains fixed. Every year the payment amount is the same. The interest portion starts at $800 and it goes down. The interest portion will go down each period because you're paying off the balance. The principal portion increases each year because more and more of your payment now will go towards reducing the balance in the form of principal. We use a simplified example of 3 years with yearly payments to demonstrate the calculation. The same logic applies to mortgages over 30 years with monthly payments. The textbook shows an example for an amortization table of a 30-year fixed-rate mortgage. It shows the monthly payment amount. It went through the same calculation for the interest in the first month, the equity or principal portion in the first month, and the remaining balance at the end of the month. So the term equity and principal is used interchangeably. Here is the interest versus equity over time. The red line is interest and the blue line is equity or principal. The mortgage amount remains the same. This is a fixed rate mortgage. So the mortgage every single month is around $1,750. But in the first, in fact, up to here, 216 months, the interest portion is much larger than the equity or the principal portion. So your first few payment, in fact, your first few years payment, the majority of your payment goes towards interest. Later on in the mortgage, in the last few years of the mortgage, a majority of your payment will go towards equity or principal. For a 30-year mortgage, after year 19, the equity portion will be larger than the interest portion. What that means is in the first 19 years of your payment, the majority of it will go towards principal. Now, what about mortgages that are not fully amortized? How does that work? We have seen in Chapter 5 examples of making payments that do not cover interest, and what happened in that case is your balance keeps growing. Graduated payment and interest-only mortgage are both examples where you're not paying off the loan at all. Balloon mortgage, on the other hand, you are making payments, and the payment does tend to reduce the principal or the balance of the loan, but it does not fully pay off the loan. Let's take a look at how balloon mortgages work. We saw that with a fully amortized loan, the loan will be fully paid off at maturity. If you have a balloon payment, that means the loan is only partially amortized. The way that balloon mortgage works is the payment amount is computed based on a hypothetical maturity. So the key word here is hypothetical. This is not the true maturity. The true maturity is shorter than the hypothetical. When the loan is due at the actual maturity, not the hypothetical, there will be a substantial amount remaining at that point in time. Balloon loans are typically quoted again with a set of numbers. In here, a 10-3 loan. A 10-3 loan means that the payment amount is computed based on a 10-year hypothetical maturity, but the loan is actually due after 3 years. So whatever balance you have remaining after 3 years is the amount that you have to pay off. Let's use the same example we have. We borrow $10,000 at 8%. Instead of paying off the loan in 3 years, we take out a balloon loan, which allow us to compute the payment based on a 10-year hypothetical loan term, when the loan is actually due after 3 years. So when we compute the payment, we use 10 years, not 3 years. So with 10 years as our payment time, the payment amount is $1,490. Remember when this was 3, when we amortize this over 3 years, the payment amount was $3,880. So the payment is much lower when we allow a hypothetical term of 10 years, of course. Let's take a look at the consequence of this hypothetical extended loan term. We compute the amortization table using the same principle. So the payment amount is $1,490. The interest in the first year is similar to what we computed before. You have $10,000. $10,000 times 8% or 0.08 is $800. In other words, $690, because now you only pay $1,490 in year 1. This goes towards the principal. So the next year, when you subtract $690 from $10,000, you have a new balance of $9,310. The same thing the next year, 8% of $9,310 becomes your new interest. You repeat the calculation. After 3 years, remember this is when the loan is actually due, you still have a remaining balance of $7,759. This is how much you have to pay the bank at the end of year 3. If you don't make that payment, you're still considered in default. With a balloon loan, you need to refinance unless you have that amount of money sitting around to pay off your loan when the balloon period comes due. Most of the time, what happened especially during the financial crisis, was that when the balloon term ends, people were not able to refinance, or they cannot get a mortgage at a similar rate, and they end up defaulting on their loan. Balloon loans are dangerous, and it has special use, and it's more common in commercial applications, but for individual or personal finance, balloon loans can often lead people into troubles. We'll end the video here. In the next video, we'll go through step by step of the house buying process. See you soon.